I think we can start now. Yeah, I think we can start. We have quorum. Good morning, good afternoon, good evening from where you are joining us from. My name is June Mukangula. For AESIS, I support with pre-summits events such as the virtual series like this one today, and also the investor meetups and also the awards at the end of the summit. And today we are glad to have you for the first series, and I'm very excited because I have missed you guys. The last time we spoke for our ACES session was in November last year. So we are so happy and thrilled to have you this year. And the series is to build to build momentum for the summit, but also to educate, to have these conversations as we wait to have them in Cape Town, to educate investors, to talk about trends, to talk about challenges, upcoming markets, and see how we can grow the investment landscape in the continent. And today we're having our first session on capital with conviction, what makes investors write the check. And before we get into that, I would like to know where you're connecting from today. For me, I am connecting from Nairobi, Kenya, which is very chilly. So feel free to put it in the chat where you're connecting from. Also, you can share where we can find you, be it on LinkedIn or even your website, and let us know what you do. And we are willing to network. So yeah, as we build the community, just to read out loud. Um, we have here from Amsterdam, we have Grady from Kinshasa, we have Cape Town. We'll see you in Cape Town. I hope we can see you at the end of the year. We have Julie from Amsterdam. I'm seeing Ben is smiling and he's not putting where he's from. Or has he put great to be here with you? Why are you not saying where you are? We have Dar es Salaam, we have Lusaka, we have Abidjan, we have Pretoria, we have Guinea. Yeah, we have Malawi. So, yeah, we have a great representation of the continent. And this is what we love here at ACES. We also have people from the diaspora from Denmark. So, yeah, we are glad to have you this evening or morning from where you're joining and to have this meaningful conversation. Just to walk you through a little bit of the agenda, we are going to look at what to expect for ACES 2026. And then we will later have an investor fireside chat and an announcement and closure. We intend to have this session for an hour. So we hope to be able to we hope to be able to expand your knowledge on what makes an investor write a check in that duration of 1 hour. And right now, I will call onto our program director, Yao Pepra, to come and introduce to us what to expect for ACES 2026. Yao, welcome. Yao.
Sorry, yeah, sometimes my mute gets stuck. Hi, everyone. Thanks for the introduction, June, and hello to all of you, and thanks for taking the time to join us for this session. Just a quick update. Just for those that actually don't know, Africa Early Stage Investor Summit was started by ABAN and VC4A, and this is the 13th edition of the conference or of the summit or of the gathering, depending on how you want to place it. But it's really a gathering of investors by investors. That's the primary focus. On the secondary side, we also realize the need for some portfolio companies that are investor ready to come and present what they have to offer. But ideally, what the conversation is or what the gathering is for is just to see who's doing what on the continent, how we are doing it, and how we can do it better. So it's morphed over time, and we keep on listening and learning and trying to be better. And so with this edition, 13th edition, happening in Cape Town on the 25th and the 26th of November, we want to try and change the strategic framing. Well, not change it, but just I guess build on it. And with the arc that we're going to be following is really more from a data-driven framing and moving towards radical transparency. And how that's going to, I guess, unfold is on the first day of the conference, we will be announcing a long-term strategic partners shortly. And through them, we're hoping that we will be able to get the right people in the room who are investors to have a conversation, and we want to discuss who's doing what, how we're doing it, and how we can improve on it, where our failures are, where our successes are, so we can, in the end, make sure that we succeed for those that I guess we all serve, which is the early stage community on the continent. The engagement engine, we realize as well that a lot of reasons why people come to AESIS is to engage. It's almost like I mean, I hate to make it sound so trivial, but it always seems like a family gathering, where people. Last year we saw how people were just, it's not even just last year, it's like all the time. People are just so engrossed with engaging with each other that sometimes the panels take a bit of a backseat. And I suppose we can, in a way, understand why. So what we're going to do is we're going to look at how we can get more relevant content for people and also provide space for people to engage. So at the initiation phase, we're going to have our opening cocktail on the Tuesday evening. And then we're going to have curated investor experiences that people tend to love. It provides a really necessary space for people to just have an informal engagement, dialogue, just meeting people outside of the summit setting. And you'll form those relationships and you'll take them on to the next day. And then we'll culminate with the awards dinner on the evening of the final day, which is on Thursday. And that's really just to acknowledge those that are playing a significant role and to let them know that we see you. And discussions are always one thing. So what we're trying to do is maybe this year we want to encourage more peer learning, connecting and reconnecting with people that you met along the way, and then hopefully getting some deal flows as well going through. But we, if I'm not mistaken, Ben, Thomas, and those that have come before me, we try not to be a talk shop. We really want to be a place where we put forward actionable conversations. So I think I've spoken enough, and so I'll hand back to you, June. And I really appreciate you guys taking your time to be with us. I never really introduced myself. My name is Yao. I am, I guess, the partnerships lead for AESIS this year, and I also work for VC4A as a special project lead, and this is one of our main special projects. And so, if you were looking to join us on this journey, please do reach out to me. But also, I have to put a caveat: there's very limited space for portfolio companies this year. So if you want to partner and bring some portfolio companies, get in quickly, get in there. All right, thanks, guys.
Thank you. Really, we do have exciting things awaiting you guys in Cape Town. And yeah, we hope to see all of you there. And please do not miss it. We have exciting things. And now I will call on Lina who will welcome our panelists today and so that we can kick off the discussion.
Hi, everyone. Can you hear me correctly? So just so you know, there's a bit of change on my end. If anyone lives on the corridor Abidjan to Douala, you understand the type of rain that is happening right now. And yes, so it just started like crazy, and the internet is obviously, or the light is going in and out. So realities of the business here. So apologies, June, I don't have the background anymore because I'm joining from my phone, but I'm very, very excited to host this session. I think we have three great people to talk about the topic at hand. I'm going to do a quick introduction and then we're going to go straight into questions. But if obviously I missed something in your bio that you want to emphasize for the audience, please don't hesitate. So today we have Wanji, who is the East Africa Director of Acumen. It's one of the pioneers in terms of providing patient capital investment in Africa. She leads Acumen's East Africa portfolio with a focus on energy access, sustainable livelihood, and brings a rare combination of commercial experience across off-grid energy, clean mobility, and impact investing. It's wonderful to have us with you here, Wanji. We also have Juliet, who is the Director of Early Stage Finance at FSD Africa, where she focused on how different form of capital, right, can catalyze innovation in supporting Africa Green's economic transportation. She brings over 20 years of development finance experience across the continent and has become one of the sharpest voice in this ecosystem. And final but not least, we also have Ben, who is the founder and director of VC4A, where he built since 2007 from scratch into the continent leading online platform for African startups. I think for all of us, when we're looking for startups, we typing, most of the time we get a link from VC4 for A. So it now has over 250,000 members across 179 countries. He's also the co-founder of AfriLabs and of course of ABAN. So wonderful to have all three of you here with us. And I'm going to start with a very general question. When you hear the phrase capital with conviction, what does it mean to you personally as an investor? What does it mean to you in terms of ecosystem? And how do you see it shaped depending on the geography? Because we also going to acknowledge that we don't have one Africa. We have multiple, multiple ecosystem on this continent evolving at different pace. And maybe let's start with you, Juliet.
Great, thank you. And really nice to be here and on this forum. Thanks so much for inviting me. So yeah, early stage finance at FSD Africa, we're really investing in the capital providers that are providing the finance to businesses in Africa. And so for us, it's really less about understanding the certainty, the absolute certainty of something, because obviously you can have huge amounts of data, but at the end of the day, you're never going to be absolutely certain with conviction about what you're investing in. I think for us, it's more really about understanding the nature of that uncertainty and whether it fits within our risk profile. We at FSD Africa have quite a high risk profile. We take quite bold moves, often first mover moves. And so we're really trying to come in first and use our capital with conviction to then enable others to come and follow through with us. And in doing so, I think we need to have confidence in the partnerships that we're investing in, so the people that we're investing in, and also confidence that we can contribute as a market builder to the non-capital elements that are required. In terms of geography, Lina, we're very interested in moving beyond the big four and trying to get into other markets. And that does require capital with conviction and some bold moves. But I think that's really is the nature of the role that we have.
Excellent. Thank you for that. And one thing I forgot to mention, I want the audience to participate. Sometimes I may, when I run the class, I usually call out on people. So if you have any questions, I promise I'm not going to call on you. But if you have any questions or reactions to anything that we are saying, please don't hesitate. We would love this to really be a discussion with you and not just a panel that you are sitting through. Thanks again, Juliet. So Wanji, what is your answer to that question? What does capital with conviction triggers within you as an investor?
Thank you, Lina, for your question and for having me here to have this conversation. I think it's an honor. So for us, I work for Acumen and we're patient capital providers. We underwrite checks to entrepreneurs, early stage entrepreneurs. By the time we're coming in, they've been able to raise friends and family rounds, but many times they've not been able to raise commercial capital. And so for us, conviction is not just the feeling we have at signing. It's not the enthusiasm about the business, but it's about the capacity of an investor to stay with the business, especially when fundamentals shift. And early stage businesses, many times, what they think the growth trajectory will look like almost always does not follow the same path. And so conviction means that as an investor, we sit with the entrepreneur and help them grow through the challenging pieces for them to be able to grow and be able to fully be able to raise commercial capital. With regards to regions, I sit out of our Nairobi office, so we're focused here on East Africa. We have colleagues that are in West Africa and focus there, but we also have strong interest in entering the Southern Africa and Northern Africa markets.
Thank you so much. And for you, Ben, what does it mean, capital with conviction? What do you hear?
Yeah, I think it means writing the check when you have a lot of reasons why you shouldn't. There's always going to be this risk, right? There's execution risk, there's the currency risk. The exit options are limited. It's vague. It's, could be down the road one day. The governance is still messy. First, almost certain policy is going to get in the way, and there's going to be a lot of other challenges that give you a lot of reasons why you shouldn't do it. But then, you have this founder, you're understanding these customers, the demand that they have for the solution and this market that's building. And you simply come to this question where, yeah, the company could fail, but if this works, I want to be a part of it. And so, the solution is compelling. You see the company is solving a real problem, and then you meet the founder and the team, and you understand that they actually have the best chance of navigating the challenges and finding the opportunity. And then it's simply, it's time to go.
Yeah, no, and I everything that all three of you said, obviously, I fully agree. As an investment manager at Launch Africa, we sometimes are faced with being the first VC ticket that a founder will get after some friends and family round. And talking, when I was asking the question about geographies, it's because access to capital is obviously a lot harder outside of the big four. So we've tried to look at places like, not just Senegal or Morocco, but also, geographies like DRC or, Algeria that do not typically attract a lot of the capital. But I'm going to stay with you, Ben. When, as we talk about this capital with conviction, you've seen now since, you've been at this since 2007 at least, and through VC4A, I'm sure you've seen some changes. What has sort of fundamentally changed about investor conviction, especially since the funding boom of, the post-COVID session where it felt like everyone was sitting down and writing checks or asking for money? What has changed since that boom?
Yeah. How many lives have we already had? I think in terms of me just trying to understand where we are, I think we've had at least 4 phases. Maybe we're kind of young adolescents at this stage. So you had this, at least from my experience, right? The first phase was kind of this market activation, maybe between 2007 and 2020, which it was really, kind of around, can we build the foundations? Can there actually, can we establish a pool of entrepreneurs that have the capability of turning problems into compelling ventures? This is when, AfriLabs now, there's more than 500 hubs that are part of this network. There's now more than 75 angel networks that are part of ABAN. There's the 28,000 startups that are, connected to VC4A and the many other, fantastic organizations and networks out there that I think have really shown that there is this entrepreneurial potential. Then, as you said, right, we had COVID, and following COVID, I think kind of by surprise, we had the boom 2020 to 2022. We went from 2 billion in funding to, AFCA was estimating, I think it was in 2022, that we surpassed 6.5 billion in funding for the venture market. Valuations started growing very quickly. Capital seemed to be abundant, and I think there was this FOMO, right? There was a narrative that was saying you need to get into this massive market opportunity, and that was driving a lot of demand. Unfortunately, the party also ended, right? This was kind of the third phase, and so if you were a toddler and everything was a fantasy and the world was your oyster, then you start to grow up, and then you have your first bicycle crash, and you start you scratch up your arm and you bang up your head. So we had this correction between 23 and 25. Funding fell by more than half. And I think for the investors and for the entrepreneurs, there was this massive shift that all of a sudden it was, how much cash do you have? How are you managing your resources? What does your runway look like? And then all of the economics, the unit economics was the main focus again. And so then, where are we today? And I think, and I'm curious to hear how my colleagues look at this, but I don't think this correction was something that was temporary. I don't think that we should be waiting for this moment where the market kind of comes back the way that we saw it at the end of 2022. It's actually a structural sort of realignment to this reality that we're living, right? Like we have the experience, we see what works and we see what doesn't work, and we see why things are really hard sometimes. And so, the funding resources and the funding interest for these problems aligns to that reality. So, I talked about venture metrics, right? People want to know, what is the depth of the business? How sticky is it? What's the resilience of sort of the relationships that are being built with the customers? How dependent are the customers on these solutions? Angels and VCs are now really thinking about the exit from the start. I think liquidity is something that we're going to be talking a lot about. It's liquidity for the LPs, it's liquidity for the fund managers, and then it's liquidity for the angels. And to be honest, I think it's also liquidity for a lot of the founders. Building a Series A opportunity in the African context takes longer than it does perhaps in other parts of the world. Is it fair for us to expect these founders to be bleeding at the gums for 10 to 20 years, right? Where is their liquidity? So I think there's a lot that needs to kind of be unlocked if we're going to bolster the conviction that we have for the market and for the entrepreneurs that we're trying to support. And then of course, so you have this in closing maybe, but you have this retraction in sort of supply of global funding. I think there's two things that are also very, very relevant at the moment. One, thankfully, with organizations like FSD Africa and many other like-minded institutions, there is a space for innovation. And there is a space for trying to build solutions that help the market perform more effectively and with greater efficiency. And then two, there's a growing appreciation and also a recognition that local capital is going to be the determining factor in sort of Africa's resilience and the long-term sustainability of the venture ecosystem. And so these are areas that are getting a lot of attention, and I think that's where we're going to see progress.
Okay. Thank you for that. Thank you for that, Ben. And I think there's a couple of things that I saw the members of the audience reacting to, and that I wanted to point out. The correction of the market, which also affects liquidity, because correction is essentially not just in fundraising, but also in terms of valuation, and the importance of local capital. But I want to switch it up a little bit, especially as we, part of capital, like you all mentioned, capital with conviction is really essentially investing through uncertainty. And when you do it on our continent, it's even greater uncertainty. So for you, Wanji, as you back entrepreneurs taking truly difficult development challenges, usually sometimes through an entire vertical, how do you build conviction when success is not even immediately visible?
Sure, Lina. Okay. So I said that we come in early. I said that many times when we're underwriting a check, we're the first commercial checks that our entrepreneurs are getting. And so there's a couple of things we've learned how to do and are continuing to learn and continuing to iterate. When we're making an investment into a company, we have a value creation plan and what we think the growth trajectory of the company is going to look like. So while we're making the investment, we have a hypothesis of how the growth is going to look like, the period of time that we want to hold the investment. What we do to make sure that we are measuring the success is that at month 6 or month 12 or month 8, we're tracking certain matrices dependent on the business, dependent on the model, to make sure that the business is growing. We're checking, for example, their cash conversion cycle, the growth in their margins. We're deploying capital. The capital is going for certain purposes, and those purposes will cause the overall success of the business. And we plan on matrices, like we measure matrices every so often, that we can make sure the company is tracking to the goals and the ambitions that we have for the organization. So that's one of the things we do. The other thing is, while we're deploying capital, we also tranche our capital. We structure instruments that are measured to work with entrepreneurs to help them grow at the stages they are. All this while we're building conviction. It can be an instrument that has a repayable feature. The more the company is able to repay, the more we're building conviction in the model of the company, building conviction in the capacity to pay, etc. We also many times we predominantly underwrite equity checks. And when we underwrite equity checks, we're taking board seats, and governance is a big piece for us. And so board seats, information rights, I've spoken about tranching. It allows us to be able to test our thesis in real time. We don't have to wait for an annual report. We're getting reports monthly, at least, to have a sense of how the company is tracking, what they're doing. Is our thesis going according to plan? And in instances where it's not, how can we pivot or support the company to pivot to be able to meet their objectives?
Thank you for that excellent answer, Wanji, honestly. And I think it's something, we have a lot of founders about the audience, and what you were talking about, the time frame of measuring, right? The 6 months, the 12 months, but most importantly, the monthly report. And in a question as big as around capital with conviction, I think for you, the founders in the room, one of the things that is quoting under your control is that reporting, right? Even as you go through the conversation with the investor, and it's something that I emphasize quite often, if you want to help build conviction, you have to ensure that you provide the reporting that helps us understand and get more aligned with you and what you are doing, and even sort of drive us, the investors, to help you. And someone mentioned someone talked about or asked a question around the different type of fund, right? Doing a 10-year fund versus a permanent capital vehicle. Juliet, I want a bit of your opinion on that, especially as someone who has looked at different forms of capital, right? You've looked more like equity, grant, debt, but let's talk a little bit also about the cycle of the investment and your opinion on that. What are your thoughts around this idea of our funds are too short in terms of time, which puts a certain pressure when it comes to liquidity and exit and so on? So how do we evaluate like the 10-year fund, the permanent capital vehicle?
Yeah, thanks. I think it's a challenge, and I think my general conviction is that those kinds of the kinds of traditional models that we've inherited from elsewhere are not always fit for purpose for the continent, and that we need to be thinking about things differently and sort of developing models that are a bit more Africa centric. Obviously, we have those models in play and they're not going to go away overnight. I do think that there are challenges around that sort of 10-year plus 2, kind of fund structure, closed-end fund structure, because it doesn't necessarily match the typical growth rates of African enterprises. I mean, yes, we have some rapid high growth unicorns and things, but they're very few and far between. I think the majority of enterprises that we see in the growth phase are very solid but moderate longer term growth type entities that require different types of capital. So I think we do need to challenge those kinds of structures as an entity. We do think the permanent capital vehicle can play a very good role here. We do find, and we have invested in a couple of permanent capital vehicles ourselves for the reason that they are providing appropriate finance, particularly within the climate innovation space where we're most invested. But we do find that those permanent capital vehicles, again, sometimes struggle to fundraise because the investors that they're trying to raise funding from, are structurally bound to certain rules and regulations about what they can invest in and what they can't invest in. So it feels like there's a whole sort of mindset shift that needs to happen, and we need to challenge, and maybe that's a role for AESIS, is to bring the audience together and really start to challenge those kinds of structures. And I think what's encouraging is just seeing so many different new structures that are coming into the market. It's no surprise that sort of self-liquidating mechanisms are becoming more common. Venture debt is increasing, and that helps to build that liquidity that we all need and those exit paths that we all need. And as Ben said, that we need on all sorts of different levels, not just one level. So I think there's a big job to do to really try and navigate and build some more Africa-centric structures.
Thank you for that, Juliet, and point well taken on the permanent capital, and again, liquidity and exit coming back as keywords. I saw you on the chat talking about valuation, making sure that the capital coming in initially, you think about how you will get out. And this is not just from the investor perspective, but it's also evident from the entrepreneur perspective. And I'm going to go to you, Ben, because you put evidence-based. So outside of, for example, we talked about reporting so far. Outside of that, what can entrepreneurs or investors do to build, this sort of to strengthen, the conviction of investors in our ecosystems? You really did a nice job earlier talking about sort of our evolution of the ecosystems on the continent. So as the stage that we are in, how do we get an influx, right, in terms of conviction for investors?
Yeah, I mean, also maybe just first reflecting on Juliet's point. I think as a community, we because we're in it, we don't necessarily see how quickly things are changing, and how, I mean, we all want it to go faster. Trust me, I've been in this seat for a long time, and I am blown away that we're still dealing with some of these questions. At the same time, like on the debt piece, if you look at the composition of capital, equity funding, going from 4 billion in 2021 equity to 1.9 billion in 2025. On the flip side of that, debt funding has gone from 300 million to 1.2 billion. Right? Like that's a massive shift in the type of capital that is coming into the market. And that represents, an entire new set of tools and financing solutions that are available to companies, right? So it's providing capital support, but of a completely different nature. And it's not for every business, right? And we talked about like a permanent capital vehicle. It's not a single solution, right? It's about having a whole collection, a whole toolbox of solutions, so that we can meet every challenge where it's at, and be, really sort of increasingly focused on, what is the actual need and what is the appropriate solution or the appropriate piece of resourcing for that. Also, just in terms of like the geographic distribution, we have this narrative around the big four that continues, which is, and I think will continue to be more than 80% of the funding that goes into the continent. But if you look at like a country like Tanzania, there were 6 deals in 2020. That was 35 deals in 2024 and 24 deals in 2025. You see the same thing in Morocco. It was 2 deals. In 25, it was 29. In Cote d'Ivoire, it was 4 deals. In 25, it was 21 deals. Uganda went from 4 to 19. So even if you don't see on the top level that the funding is, that the sort of ranking of countries is changing. The number of deals that you're seeing in other geographies is significant. Like where there's definitely something that is happening today that wasn't happening 3 or 4 years ago. And just adding one final piece to that is around the sectors. It was fintech, everything was fintech. It's still 40% of the funding, but we saw 79 deals in logistics, 63 in energy, 62 in healthcare. There were 30 deep tech deals. There were 18 in waste management. The energy and water sector is 20% of the capital that is being invested on the continent. So you're seeing entrepreneurs tackling really difficult, parts of the economic system, but you're also seeing investors respond to those opportunities and putting money into those businesses. So, when we're going to the entrepreneurs and saying, hey, this is our advice, or, this is what you should do better or different, or, how can you help develop conviction? I think it's about building companies that matter, and then being very honest about how you're making progress, but also the challenges that you're facing, and having that self-awareness and the openness to get support and to collaborate and work with other people. Because anyone who's trying to do this stuff in isolation, same message I would have to angels, or same message I would have to VCs, right? If you're not embedding within a community like AESIS, you're really not making your life any easier. And I think, the more that we can kind of think through the lens of partnership and collaboration, the easier a lot of this is going to get. But I'm going to hand it back over to Juliet and some of the others.
Yeah. And those are, sorry.
No, Lina, I did just want to plug, because we've actually launched some research today, in fact, which is why I want to plug it, which links to one of the comments that Ben was making around the landscape of investing. This report is specifically around climate innovation investing, but nevertheless, it is showing these trends around the investing that's happening at a subsectoral level. So I'm going to put the link of the research in the chat so that everybody can have a look at that report.
Mm-hmm. Thank you so much, Juliet. Yes, I appreciate it, because I'm going to check out the report as well. And to just reinforce a couple of points that Ben made for the audience around collaboration. One of the things I often tell founders is you also need to do your due diligence. So don't work in a silos. Talk to other founders about the investors. It's part of the thing. We do it. Right? When we look at deals, we go and knock on the other investors' doors to be like, hey, have you seen this deal? What does that look like to you? What are you evaluating? Now, it potentially creates a bit of herd mentality, but the idea is you are at least collaborating. And I think the same can be done, as Ben was saying, for everyone. And the other piece is when there's all these reports that talk about how much funding was raised, I wish next to the amount, that there was a percentage growth that was placed in terms of number of deals and money. Because Ben is right. I essentially cover Francophone Africa, from Algeria to Madagascar, going through Senegal, Cote d'Ivoire, DRC. And one of the things that I have seen is that trend, but it's not as visible, because the report will always come back with the big four. So I think one of the ways we can also help with conviction is showing those percentage growth and not just the absolute numbers. And showing in this sort of idea of investors going to a wider range of founders and sectors and geographies. When we look at companies that matters, I want to come back to you, Wanji. You're looking, let's say, I'm putting a scenario. You're looking at a company that matters. It's a problem that is a big deal. But what are the fundraising mistake, or the mistake in general, that you see founders making or repeating time and time again, even though they are building companies that matters, that are solving real problems?
Sure, Lina. One of the first things I'll say is not having the data that investors many times will ask for. So we'll find a company, we really like the company, like the entrepreneur. I think it's because of the fact that we come in fairly early, not fairly early, but yeah, decently early. And so many times when we're looking for information, we will not get everything we're looking for. And what I'm speaking about is we'll ask for a data room. We will want to see your financial statements, your governance structures, all in one place. And so one of the things I've seen, one of our biggest pain points is trying to support entrepreneurs to create these resources internally, not just for Acumen that might be diligencing or looking into the company, but for others as well. So it's helpful for others. So that's the first thing. The second thing I'll say is, as equity investors, that I tend to see a lot of is I think it's the emphasis. There's a lot of entrepreneurs might be stuck on the what am I worth and what is the valuation of the company more than what can this capital do for me and how can I grow from where I am to where I'm going to be. And I think there's a mindset shift I would really like to see us all employing. I think there's in previous years there's been, pegging valuation to comparables in different markets, which might not be a true sense of what the position in a market on the continent might look like. And I would really like to see a departure from that big anchoring on a valuation of a company and more on an anchoring towards what is this capital going to support me to grow into, even with deferred valuation, even with differentiated structures, things like convertible notes where you can peg your valuation at a later date. I would much rather see us moving into or evolving into that path.
Excellent point, Wanji. I want to jump back on a couple of things. So start with this idea of being stuck on worth and valuation versus what the capital can actually do for you. It's an interesting exercise sometimes with founders where I know for me, I go back to the math for the investors is the exit. I have to exit at some point and I have to exit within a certain amount of years. So if you're telling me you're worth 20 million today, if I'm investing for 20 million today, are you telling me that in 4 to 5 or 7 years, you will truly be worth 100 million? And if that's the case, how many companies have gotten close within your geography to that valuation? You may be the first one. I'm not a joy killer. You might be the first one, but to be the first one, let's see at least some that have maybe gotten close to that. And like you were saying, pegging those valuations to geographies that have nothing to do with us. At this point, yes, India is part of the global south, but it may not be the right geography to peg yourself against because the advancement in terms of technology and infrastructure is just very different for a lot of our ecosystems. So it's really worth it to more think about, today I'm raising this. I have this amount of ownership within the company. This is what the capital would do, right? And I will have, I don't know, I'm saying crazy numbers, 70% of what it is today might actually be less than having 50% of what it will be tomorrow because of the capital that has been injected. And on the lack of data, we do see it as well as at early stage investors, which brings me to a question that came into the chat. Lack of data can be one of two things. Either the founders have, they have things in their mind and they just haven't put it on paper. And for them, it's so natural, they don't realize the level of education they have to do with the investors. Or it's a lack of skills. They're not used to sharing data. And there's been a growing movement or growing talk around venture studio. So I guess I will go to you, Ben. What are, and I'll ask that to all three of you, but let's start with you, Ben. What is your thoughts around the venture studio model in our ecosystems? And I say systems with an S because it may not be fitting for all the ecosystems. What is your thought process on what type of founders, what type of sectors? Is it even a model that really works on the continent? Should it be tweaked? What are your thoughts?
Yeah, a couple of things come to mind. I think one of the other factors at play is companies being under-resourced and having limited capacity to also spend time thinking through the growth strategy for the company. So I meet a lot of entrepreneurs that are just they haven't really taken the effort that's needed to develop a more thorough understanding of how they could actually grow the company. So they know they're raising money, but being able to explain how the money is actually going to change the business and why that's going to be good for shareholders, there's a whole piece there that I think needs a lot more attention. Venture builders, is that a solution? I think so. One of the concerns I have around it is actually the teams that are trying to build these studios, because I don't think you can underestimate the time that it takes to develop something from concept to market. So in some ways, it's almost shifting an existing problem, and if the venture studio isn't properly capitalized, they're going to run into the same challenges and the same problems that everyone else is running into. So yeah, I think it's great that we're seeing this explosion of studios across the continent, and I look forward to seeing many of them go on to become very, very successful. I think we'll also see many fall apart along the way, because it's not any easier than what anyone else is doing.
Excellent. Wanji, what are your thoughts? As you've looked at different founders and and good companies, have you come across a few of them coming out of the venture studio? What has been your experience so far?
Lina, yes. So I want to agree with Ben. We have found a few companies in our portfolio have come from venture studios. What I think has been fantastic about them is the overemphasis like the emphasis on a problem, create solutions specifically for it, with specific types of expertise that they have handpicked to solve those solutions. That I think is great. It brings a lot of value in the ecosystem for the entrepreneurs that are in the market. That's the pro. The con, I think, has been the harder part. The harder part where you have the technical skill, but the operationalizing of a solution is not, first of all, it's not a straight line, meaning what you imagine the path to figuring out how you're going to get a solution or deploy a solution to a market is not linear. And so I might know the problem we're trying to fix is A, but when we go to the market, the hurdles that we find are B, C, and D. So the first piece is the realities in the market versus what it is you're conceptually solving for. The second piece is, to Ben's point, the amount of money that you need to operationalize this business and get it to have some traction, make some revenue, etc., tends to be a long stretch of time. And so completely agree that they have to be well resourced because of that long period of time to operationalize. I think has been what I've seen a lot of times.
Thank you, Wanji. I appreciate that. That is definitely in terms of operationalization. Oof, I can't even say the word. I don't know how you said it so smoothly. And the deployment of those solutions. I know I've questioned myself whether does it become even more expensive, to deploy a startup through a venture studio versus the typical working with getting access to a founders directly, or they have gone through a simpler, so to speak, investor readiness program. So to you, Juliet, as you typically support the system more than just specific companies, what has been your experience with Venture Studio? Is it a is it a hallway, if I can put it that way, that you see FSD or others supporting more? Because we've talked about the need for capital for those venture studios to be sustainable. What are your thoughts?
Well, I think our experience, in all honesty, has been less with venture studios per se, and more with experimenting with different value creation approaches that either come alongside or are integrated into investment products. So, for example, and that's what we've got most experience with, and I think because we then invest in those funds or those capital providers that are experimenting with those approaches. So, for example, with Catalyst Fund, they provide equity, but 25% of their equity is actually in venture building support, and that is created in a bespoke way, and it's determined by what that company needs, and the experience that we've had through that is that that kind of venture building support is really valued, and it has a price tag, and so people take it very seriously, and it is adding value to those businesses. So whereas in other models it's earned equity in the case of Holocene, which is another investment that we've made, or or it's a TA facility in the case of the Climate Resilience Africa Fund in Egypt. So there are different models, and so in fact we're going to be doing some research with IMP around building on some of the venture studio research that's been done by Brighter and FMO, looking at these other value creation approaches and not coming up with the best way, but just coming up with, well, how do these work in different circumstances, and importantly, how do we make them sustainable? Because I think that is the underlying question, isn't it? Is how can we, make them as sustainable as possible?
Exactly. And I think it fits back with a point that Ben put in the chat, and that was also essentially what I was trying to communicate, which is founders I think they underestimate how much time and money and energy they put into developing the ventures before they come to us investors. Whereas, the venture will sort of take better stack of everything that has gone through, because that's part of their business model. Hence the question for me of, is it more expensive ultimately to go through a venture studio? And if it's more expensive, is it worth it in the end? And obviously that's not a yes or no answer. It will probably depend on situation, ecosystem, sectors, and so on. So with that, we're going to go from venture studio to sort of, there's been a lot of these investment readiness program. So your input on that, because that's a bit different from your the definition itself of the venture studio. And let's start with you, Juliet. So what have you seen worked with these investment readiness program, if any, and if you've supported any, if you have any example, and what are your concerns with some of those?
I think well, in addition to the ones that I've mentioned, which are, have some elements of investment readiness in that they are getting companies ready for the next wave of investment. I think the main experience that we've had is we've got a carbon accelerator program that is getting carbon companies ready for investment. And I think what we're learning from that, we've got 7 projects that we're investing in at the moment, and we're going to expand that portfolio. And what we're learning is that there's need for that deep technical expertise and support there to come alongside the networking, the links to the buyers and the investors, and the sort of more generic kind of how do you present yourself to the investment community kind of skills. So you definitely need to have both of those coming together, and also sort of having links both with sort of local investors on the continent as well as some of the international investors. I mean, that's relevant for carbon. It might not be relevant for all business models, but it is often relevant for carbon. And
Makes sense.
I think one learning there is the use of instruments like returnable grants. So you are building in some level of accountability. It's not a pure grant that you're providing. You're building in some level of accountability that can, that this money can be paid back over a period of time, triggered by certain milestones.
Perfect. And Wanji, for you, your experience with investment readiness program in the ecosystems you cover in East Africa.
So, Lina, a few years ago, I think I heard entrepreneurs consistently say that they were overtrained and under-resourced, underfunded and overtrained. I think there was an influx on investor readiness programs that were offering very generic programs. Acumen, on one hand, we make investments, but we also have an academy. So I'm also speaking after lessons that we've learned. What I'll say is there is need for them 100%. I think there is need for them when you're going deep, like you're deeply solving a problem. There are instances internally as investors, we've created cohorts for investor readiness programs to solve for certain issues. If we're trying to solve for issues, for example, one of our thematic areas is refugee lens investing, and we're trying to solve for issues specific to that with experts specific in that piece, then we can create a cohort for an investor readiness program and run it. My point is they're beneficial, yes. I think a lot of times there is duplication with regards to a curriculum that is being offered. I think what is valuable for entrepreneurs is when there's in-depth learning to specific topics.
Okay, awesome. Thank you for that, Wanji. All perfect points. So I'm going to ask a question for all three of you, and I'll start with you, Wanji, because you are the last person to speak. But I'm asking the audience to react to the answers that you will give as investors. So, what is the biggest misconception founders have about how investors make decisions? It might take a minute to respond, and the reason I am asking the audience to react is because it will be interesting to see what we see, and if there are investors in the audience as well, please participate. It will be interesting to sort of compare from a founder perspective and from an investor perspective how we answer this question. So, Wanji, what is the biggest misconception you think founders have about how we investors make decisions?
It's a really interesting question. Biggest misconception that entrepreneurs think about investors when they're making the investment decision, right?
Yes.
I think, okay, so I'd say investors make, I'd say perhaps entrepreneurs imagine that investors have made their decision. I'd say the decision by the investor is made over time. So it's not made on the first interaction where you've pitched your company, you've shown me the model, how it works, etc. I'd say contrary to belief where it's a short decision, I'd say it's a long decision that is made. It's sort of deliberated, agreed on. We're building several blocks as we're interacting with the entrepreneur. There are instances, for example, when I have not even met an entrepreneur, but maybe run into them on social media. I'm starting to interact with them virtually. They don't know me. I'm starting to learn about them. I'm building the hypothesis over time. By the time I'm meeting the entrepreneur, they might think that that decision was made over a couple of interactions. Yet what has happened is that decision has been slowly been building over time.
Very true. Very true. Sometimes founders don't realize that we've met them before we actually met them, even through a customer, right? One of the ways is either a founder on your portfolio already that is a customer of theirs will give you some feedback on their needs and whatnot. Ben?
Lina, I want to say one thing. Sorry, let me say one other thing. The other thing I'd ask is that as an investor, we're not looking for perfect businesses. So when I'm coming to an entrepreneur, I want the entrepreneur to understand that I don't imagine the business to be perfect. I don't imagine, I want, I think entrepreneurs imagine we're looking for perfect businesses. We're not looking for perfect businesses. What I'm looking for is a business that I have conviction on it. I also quite like during diligence when I meet with founders that are open about the challenges of their business upfront so that I don't have to dig into diligence to understand the bigger challenge, like the problems of the business. If you're upfront with me and say, my problem is A, B, C, D, and I come in knowing and I don't have to spend so much time diligencing the company, your team, your suppliers, etc., that is really helpful for me.
That is such a perfect answer, and I think it goes with Yao put in the chat, right? Like people think the more optimistic, the more likely we will invest. No, we need you to be just fully aware, because from us, you are the expert. At the end of the day, we will not know this business and even this sector probably as much as you do. We just want you to say, this is the green, right? We're doing this well, we've understood. This is the orange, and this is why we are optimistic with the orange. And this is the red where we're still trying to figure out, right? We will, as you put money into us, we actually want specifically you because we know that you can help with, I don't know, regulations or contact with others, whatever the case may be, but that you are at least aware as a founder. We all know we're not investing in perfect businesses. That's why we also are used to businesses pivoting, right? We've all invested in a certain business, and then the following year, it's not even the business that we came into the first place. So yes, transparency is key. So Ben.
Yeah, I mean, I think just tapping into that, right? Like when you hear an investor that says, "Oh, we made a decision in 2 weeks," they were only able to do that because something else was already in place. So, what is that? Where is that conviction coming from? And so, it's that trusted source. Whether it's a customer, whether it's a referral from a fellow investor, whether it's somebody from within the team, whether it's a founder that the fund is invested in previously, but somewhere there the investor is getting this signal that is already establishing a foundation. So when they come into the meeting or they're coming to engage with the company, there's already a certain established foundation in place that people are operating from. And I think founders, they overlook that. And definitely when it comes to the amount of time that it takes to develop those relationships and understanding that those relationships are for the long term, that's something that, could definitely benefit from a lot more attention.
Very true. Thank you so much, Ben. And for you, Juliet, what do you think is the biggest misconception?
Well, I think again, looking at it through the lens of the businesses being the capital providers, the early stage capital providers that we invest in, I think it's the same thing. I think it's honesty, proactive honesty. So really coming forward. I mean, the most successful relationships that we've had are ones that are built on deep trust and honesty. And when things are going wrong and they're just not, going according to plan, that is what builds our trust and our faith. Want them to be even more successful, and part of that pre-investment is about triangulating the data, as Ben and Wanji have said. And I think determination and passion. You can tell when someone is genuinely passionate about something and they're determined. And I think that is something that you can't place a price tag on that, but you can kind of feel it in a way that's different from if someone's coming with their glossy slide deck and they're putting their best foot forward and they're saying all the right things, but actually when you scratch under the surface, there's not that level of depth in terms of real commitment to the cause, whatever it is.
Yep, very true. And I want to say passion is different from desperation and different from exasperation. Because the difference is also visible from, from that lens. We are getting close to the end, so I'm going to ask for a very short answer in terms of what is one piece of advice you would give founders seeking investment in 2026. Juliet, you go first.
Well, I think we've sort of covered some of that in the last round, but it's really be yourself, be honest, share the negatives as well as the positives. What are the risks? I would, my ears peak when I hear people saying about some of the challenges and what could go wrong here, and not just sort of saying this is great, this all is smooth and excellent. Don't go in with a hard sell, just really demonstrate that you deeply understand your customers. I mean, the customer is always right. And if you can't demonstrate that you know exactly what problem it is that you're trying to solve, and what your solution is that enables that, that enables that problem to be solved, therefore who is your customer, I think that would close me off if they weren't able to say that with conviction. Yeah, you, at the end of the day, you're selling yourself and your own conviction and your own ability.
Very true. Very true. I want to add, I before I change panelist, the only other tweak I'll add to my question to you, Juliet, is what can we do to increase conviction into our ecosystems? And when I say we, it's whatever role you have. So in your role, how do you view your role into increasing conviction into our ecosystems?
Well, I think we're as a sort of investor and ecosystem enabler, we have the flexibility to perform a number of different roles in the market. I think there, for me, the conviction comes in the form of partnership. I really, and I know we talk about it a lot, but I really think we're getting to a stage of, and I've seen it, I've been at London Climate Action Week last week, there feels like there's a genuineness in the air about, okay, let's actually get on and do something together. And, I can do this, I can't do that, but somebody else can do that. And so if we come together, that builds that ability to be able to do something that we otherwise wouldn't have been able to do. You're on mute.
Thank you. It had to happen at least once. So, Ben, one advice to founders and one thing you can do to reinforce conviction into our ecosystems and conviction into capital towards our founders.
Yeah, so I would flip it a little bit, and for founders, I would tell them that they need to make sure that they protect themselves. They're in it for a long road. It's a marathon. And by chasing partners and looking for funding support, it's not an easy thing to do. And if entrepreneurs are giving everything away every time, there's nothing left for themselves, right? They're not taking care of themselves, which means that they're going to be a very poor investment if they actually raise the capital, because they won't be able to finish the marathon. And I think that's also a message to the investors and colleagues in the industry. We need to be very, very careful about how we, as LPs, if we have pressure, as GPs, if we have pressure, just simply putting that onto the shoulders of the founder isn't necessarily the way to solve our problems. And I think there's something out of alignment at the moment. A lot of the founders that I meet are they're not, I don't know, the dynamic is not always healthy. And so we need to be very careful about how we manage that moving forward. And so the entrepreneurs need to be thinking as much as they can long-term, even though they have very short-term priorities. In terms of what I can do and what we do to help further build conviction, I'm a mentor of the Serengeti Business Angels in Tanzania. One of the things that they do are Harambee evenings, which is really a community building activity. It's bringing people together to talk about entrepreneurship and what's possible through the lens of angel investing. And it's by bringing people together and spending time together that those conversations and that shared understanding can develop. And as that community takes shape and as it builds confidence and also a stronger network of trust, you see that more things are possible. And I think that's the same with AESIS. It's a conference, it's an event, but I think people who come to AESIS and who've been coming for multiple years, they understand along the way that they've actually joined something that's much bigger. It's a community of people and professionals that are all aligned with a shared mission, and we're all working together towards many shared goals. So if you've not been to AESIS, now is the time to join. And we expect to see you there in Cape Town at the end of November. Thanks.
Excellent. Thank you for that, Ben. Wanji, bring us home. One advice and one thing we can do to reinforce conviction into our ecosystem.
One advice for entrepreneurs would be to build for unpredictable markets. Even though the market realities are never straight, I've never seen an entrepreneur build a business incorporating the uneven realities of the market. And so my advice, what I'd love to see is entrepreneurs building for an uneven market, not growth trajectories that are straight looking, building with a lot of understanding of the dynamic of the market and the changing environment of the market. So that's the first thing. The second question is, how do we continue to build conviction in the industry? So for me, I'd say, especially as capital providers to entrepreneurs, we build conviction by continuing to innovate on financial structures that help us validate the value at the value with the early stage entrepreneurs. Early stage entrepreneurs as an asset class, and its value is validated as we continue to innovate financial instruments.
Thank you so much for that, Wanji. And I am going to, before I close, I'm going to tackle one last comment that was made in the chat section about misconception that VC have, that we are expecting founders to have domain experience. And that solution have been built by founders with no domain experience. They built because they were on the consumer side. I think the challenge with that is what Wanji was just talking about, which is the unpredictability of our ecosystems. We are already invested, especially when we're talking about early stage investing, when we're talking about investing with conviction, you're coming in quite early. And it's hard to add additional strain to your investment. So yes, solution may have been built by founders with no domain experience, but that is the exception of the exception. And we are already in sort of a pool of investment where the likelihood of success will be we expect it to be not as high as 80% or 70%. We know what we're getting ourselves into. So there is an expectation of domain experience, because the idea is in an unpredictable market, you at least need to know the domain and be able to sell the product. Because if you know the domain, then you know what product to build. And if you can sell the product to the right customer. That's where that expectation at least is coming from. But in being respectful of your time, I will send it back to June. But I want to make sure to thank the panelists. Thank you so much, Wanji. Thank you so much, Juliet. Thank you so much, Ben. It was a pleasure to have this conversation with you. And most importantly, thank you to the audience who participate. I really, really appreciate that. Back to you, June.
Thank you, Lina. I just wanted to confirm that I'm not speaking on mute. Thank you for moderating this session. We are excited. And also one of the things, I have noted 3 things and which are upcoming in the series. The next session is about emerging markets and not only focusing on the big four. So it's great that you have tackled that. And also we are looking at the ecosystem as it is today, because we like to say the crash of the investment has gone down, but we have to accept reality that the boom has stabilized. And also we will be looking at sectors, finance, AI, climate, and others. So we'll have investors and also feature some founders in these sectors to speak about what conviction is around these topics. So yeah, I promised you a surprise at the end of the session for those who'd make it, and I'm here promising you a beverage of your choice when you join us in Cape Town for the awards as we end. I am in charge of the awards, so at least I can be able to promise you that. And we will be happy to have you in Cape Town, but still, we will be having 5 sessions. So until next time, it's bye from me. Bye.
Thanks, everyone. Bye.
Thanks, everyone. Bye.
Yes, bye.
Thank you, guys.
Thank you so much.
Bye.
Bye.
Thank you, June, for the invite. Have a lovely day. Bye-bye.
You too. Bye.